Today, we're joined by someone who's not just weathered the ups and downs of real estate, he's also built a thriving, multifaceted investment business through it all. Today, he's going to be sharing his secrets to success. I'm Kathy Fettke, and welcome to The Real Wealth Show.
You're listening to The Real Wealth Show with Kathy Fettke, the real estate investor's resource.
Matt Faircloth will unpack how he got started in real estate, how he scaled from single family to syndication, and how he built a company and reputation that continues to grow in a shifting market. Make sure to stick to the end because Matt will share how he's navigating this current market cycle. And also, as a thank you to you, our listeners, we're giving away a couple of chapters of my book, Retire Rich with Rentals. You can just visit realwealth.com/retire rich to download it for free. Matt, welcome to The Real Wealth Show.
Kathy, thank you so much for having me here. I'm really looking forward to this.
Oh, our listeners are in for a big treat today.
I hope so. Yeah.
You've come a long way in real
Yeah,
estate. Oh man, almost as long as my journey.
I know. You see all my grades and all that. Yeah, 20 years. 20
Me
years.
too, me too.
I know, right?
But what got you started 20 years ago?
My wife.
Your wife, your beautiful wife. Yes. She's been on the
My
show.
bride, the lovely Elizabeth Faircloth. That was originally Elizabeth Rendazzi, which is way more fun to say than Faircloth.
So we should have Liz on the show, not you, is what you're saying.
Shit, so I'm fine too.
Okay.
She my wifey wife put Rich Dad Poor Dad in my hand in 2020 in 2002, when I was a traveling sales rep, and that obviously that woman and also the book changed my life. Both of them did, for the better, and it just got me into the mindset of real estate investing and building assets and working for asset growth versus working trading hours for dollars. And I just, drank the Kool-Aid. And before you know it, I was playing the cash flow board game every other week with my friends. And, it was just a great journey. And it really just opened up my eyes towards what was possible. So before you know it, when Liz and I got married in 2005, I had learned enough about real estate. Liz and I, believe it or not, while we were dating, had a few rentals. And so we had enough knowledge, we thought, for me to quit my day job and for us to live off of her income and me to build my real estate business.
Oh my gosh. Okay. Before we go on, I just have to tell you a funny story.
Please
that
do.
Many, many years ago, it must have been in 1997 around, when my friend Laura Langmeyer, who was known as the Millionaire Maker, she was on the Dr. Phil show a bunch, but back then she was just a friend and a fellow coach. And she invited me to this event where this guy was in the room. Turns out it was Kiyosaki, and he had just come out with the cash flow game, and he was looking for coaches for it. And she ended up getting the rights to it. And I was like, oh, it's cool. And Rich and I just left early. I don't know. We had something to do. So I was there like ground floor.
Board game. It's just a board game. How many people want to play that?
Yeah. Right? What? Who is this guy? I don't even know him. He hadn't even come out with Rich Dad Poor Dad yet. So funny. Anyway. Man. That book has changed so many lives. If any of our listeners have not read it, please just go get a copy. It's quick, 100%. Easy to read. Yeah.
I feel like that book has caused so many people to quit their jobs and get into real estate investing and everything like that. So yeah, short story, that's how I got here.
Yeah. Okay. Wonderful. And why leave the sales job?
Because you know what it was? I was a traveling sales for Ingersoll Rand. And at the time it was a good paying job, commissioned, selling industrial machinery, which doesn't sound like that much fun, but it was. You get to go into factories every day, see how things are made. It was very curious, fun work, right? But if I were to work my way up, I would probably have to move. I probably would have to, drink more of the corporate Kool-Aid and everything like that. And I just saw where my life was going to go if I continued doing that, which probably would mean living in a lot of different cities, maybe leaving Elizabeth Rendazzi because she probably would not. She's a little Italian girl with a mom from Brooklyn. So she's not going to live any more than 30 minutes away from her mama, and all that. So probably not going to travel with me. So I didn't like the extrapolation points of my life if I stayed with that company and continued with that career. So
you chose lifestyle and love.
Yeah, it was lifestyle. And also I saw that there was a real glass ceiling because people that were with Ingersoll Rand at the time would say things like, yeah, it's good company. They pay you just enough, in that, just enough to stop you from quitting, as a lot of corporate companies do. So I wanted to own my financial future, wanted to drop anchor somewhere physically, but I knew that I wasn't able to do that with them. Had a lot of family around the Philadelphia region that I wanted to stay close to and everything like that. So for all those things in lifestyle, as you said, lifestyle and ownership of my financial future, all those things, that is why I decided to leave them and jump into the real estate pond.
So did you kind of do both at the same time? Like, I mean, it's so hard for people to leave a steady paycheck for an uncertain one.
I should have. Looking back on it, I should have kept that nice, good paying job and bought a
Well, there's
few
something
more rentals.
about diving into the deep end. You learn how to swim pretty quick or you
I
drown.
did, man. Yeah, yeah. And I mean, it helped that I had a proverbial sugar mama at the time. Like I had I had Liz willing to be our family earner,
Okay.
while I built out the DeRosa group, which, by the way, DeRosa is her mother's maiden name. That's where that name comes from.
Mm.
So that it all roots back to a lot of her roots and everything like that. So we were able to grow faster and fail forward and tried all kinds of stuff that didn't work out, and make a lot of mistakes and all that. But it had us drinking out of a fire hydrant much faster than we would have been had I maintained the day job. If I were to speak to someone, I mean, I've spoken to students and of mine and just people that are trying to rise their real estate empires. And I've advised them, like, listen, if you've got a corporate job and you can bear it and kind of like moonlight a bit, it might be helpful to do that longer than I did. And that, so that I've advised people that, and listen, if you've got a spouse that's able to be the earner, then maybe that's worth doing as well. So that every path's there's not a specific path on leaving a day job to invest full time. Just the one that I had worked out. But there's more conservative ways you can do it too.
Yeah, it's funny, full circle here, but Liz puts on the investor event for women.
Yep.
And I was there, I think last year or the year before. And Kim Kiyosaki was there, coming back again to the Kiyosakis.
Yes. Oh my
And
God.
yeah, and one woman got up and asked a question of Kim, saying, I've got this job, it pays well, I can save money, and I'm just so scared to do real estate and leave that and dive into something new. What should I do? And Kim looked at her and said, well, why would you do that? She's like, why would you leave something you know for something you don't know,
Yeah.
and you're probably going to fail at? She's like, do it slowly, keep your job and do some deals on the weekends and until you've got the real estate build up. Don't leave the steady job. That's not for everybody, but I just thought that was interesting advice. Just Kim looking at her and saying, why would you do that to yourself?
Yeah. Yeah. I can tell you, I got a lot of my grays and lost half my hair when I quit my job and had to like be my own boss and everything else. It is very stressful. And looking back on it, I think that I probably would have been able to take down a few more deals, maybe a little more disciplined had I had a day job with income that I could then funnel that income into my real estate business. So looking back on it, maybe I would have tried it a little differently. Hey, it is what it is.
Yeah.
I grew a lot in those years and everything like that. It worked out for me,
Well,
but
let's fast forward to where you are today. This
yeah,
sounds like 23 years ago.
yeah,
So in
yeah.
that time, where are you today?
Right now, the DeRosa Group is a company that is fully vertically integrated, meaning that we manage the properties that we raise capital for, that we assemble and we asset manage and we acquire and all that. We're sitting on around 2,000-ish units in 4 states. We are mostly multifamily, but we also have a fund that issues hard money. So that's been DeRosa's growth. We found our home in residential housing that Liz and I did as we built DeRosa. We found like that's where we could make the most impact. That's where we were the most comfortable. We owned an office building years ago that we ended up selling. But that really wasn't we weren't passionate about that. We were passionate about creating, housing communities for people to love and enjoy and everything like that. I've always enjoyed that. And that's probably where my heart is in this business. So that's what we've been doing the most of now.
And you started with flips or rentals?
I did it all. And I learned the hard way that focus is key in this business. So I did flips. I did rentals. I did about 4 dozen fix and flips. I've done, BRRRR strategy, in and out single family rentals. We did wholesales. We had the office building, that whole thing. So we were jacks of all trades for a while, but our growth was kind of stymied because like you'd go and buy a rental and now it would start to go well. And then you get distracted by some issue going on at your office building, or a fix and flip would come up that I would want to pivot over to or whatever. So it was only through focus that we grew. And I started to abandon some of the fix and flips and start to not do those as much and selling the office building and just leaning all in to rentals. That's where really hockey sticked our growth, was by picking a thing, like the one, like the book, The One Thing, right? That's when growth really started to kick in.
Oh man, I think you and me both, if I could just go back to my younger self and say,
Oh
pick one.
man.
But the problem with real estate is it's also exciting and also sexy, and there's so many ways to make money in it. And you go to a real estate event and meet someone who's doing ADUs and over here, and then this person over
Oh
here is
yeah.
doing hotels. And it's like, oh, these are amazing. I want to do all of it.
I want to do
And
self-storage. Right. And I want to do this. I want to do that. And that's what happened. I'd go to my weekly RIA meeting and I'd come back and I meet this guy who's slaying it, making 10 grand. He says making 10 grand a deal, doing wholesales and everything like that. As you know how that goes. They only tell you about the good deals.
yeah.
But I'm like, I'm hearing that and I'm like, man, I should do that. So let me stop all my efforts and everything else and do this. And then you meet the guy doing fix and flips. Like, oh, that sounds amazing. So you can have real estate investor FOMO in that, but the success is really in putting your blinders on.
Yeah, just once you find something that looks interesting, go deep, learn it well.
Yeah.
Had I done the same and just focused on what we know, which
Mm-hmm.
is buy and hold rental real estate that I learned early on from Robert Kiyosaki, man, I would have avoided a lot of pain. So a lot of times, we have over 88,000 members at RealWealth now, and sometimes someone will call and say, "This didn't go the way I thought. The rent came in a little lower, or the tenant moved out sooner than expected," or whatever, stuff that happens in real estate, and they just can't handle it. But you and I both know that that's just part of it, right? There are challenges. How do you, I guess, prepare for those challenges that inevitably come in any investment, and certainly in real estate? And how do you overcome it and keep going?
Yeah. Well, yeah, I think you learn to expect that you walk into a real estate deal with a solid business plan. And you understand that plan is not all of it's going to go out the window the first day, but it will certainly change on a regular basis. So I think that the way that you handle the changes in real estate, I think, is with a really solid asset management plan. And I know that's not like the sexy part of about real estate investing. Certainly not what you see any real estate investor putting on Facebook or taking selfies or Instagram or whatever. Like, look at me in front. What do real estate investors want to talk about on social? They talk about acquisitions and how much money they raised, right? They talk about, I just bought this, or I'm, just raised 10 million. Look at me, high five me, right? But really the success in real estate investing, I found out firsthand, is what happens after that, that purchase. You don't pop the champagne the day you buy. You pop the champagne once you've executed your plan, you sell it in year 5 or whatever it may be. And that is through like really hands-on asset management. I can't tell you how many people, Kathy, I bet I was talking to a group of doctors that we were negotiating buying their multifamily from, because these are all doctors that are all working 60, 70 hours a week, all have plenty of money. They think they're smarter than us, than the syndicators, you and me. So they go and buy a multifamily themselves. Here's your problem. None of them had the time to put into running that day-to-day asset. They thought that their property manager would be able to run the whole thing for them and handle those pivots and curveballs and everything like that. You need an owner's representative in the middle of that sauce, right? And so that's how you handle the surprises, pivots, curveballs, as someone who's knowledgeable that can really captain the ship. And I've seen so many people lose assets that way. We were talking offline about people that have lost significant assets through lack of, I think that when you hear about a loss in real estate, it's because there's not someone that with their finger on the pulse day to day, being the voice of the owner and expecting the asset to run itself.
That and not underwriting it properly in the first
100%.
place, and
Yep.
being way too overly optimistic.
You got to
for
buy
sure.
right. You got to manage right.
Yeah. Yeah, it's funny you say that. We just had a real wealth investor say, gosh, I could buy a similar property that Real Wealth is selling or Real Wealth teams are selling, but then I'd have to go find my own management. And I was kind of like, And why would you do that? We work with a property manager that we've known for over 15 years with rave reviews, but you want to go buy with someone else and not have that. And it
Mm,
was just, and the markup, there's no markup. So it's like, why?
short-sighted.
Yeah, yeah, exactly. Like the asset management, like you said, the property management in our case, and the 1 to 4 units is the most important part of it.
Mhm.
You know,
Yeah.
that's who you should be basing all your decisions on, is
I
who's going
think
to manage
investors
this thing.
discount time. Investors discount the time that it takes to manifest success in this business. I think that they think all it takes is money and the right deal, and there is time that it takes to underwrite, to produce the right business plan that needs to get executed, and then the management of that plan and the driving of it. And they don't realize what it takes. I think you just buy a deal and sit back, fold your arms, and expect the property manager to send you checks. There's a lot of time and effort that it takes in driving these things forward to profitability.
So you ended up in multifamily after
Hmm.
doing a lot of single family, and often the reason for that is to scale, right?
Hmm.
You can scale more, but you also generally need to bring in other investors, so you're sharing a lot of the profit, most of the
Yeah.
profit, with someone else. Looking back, would you still choose that, or would you choose to own outright and not have other investors in the
It's
deal?
funny. I think back, I got started as a Trenton landlord. Liz and I got up to 115 units in Trenton at one point, and then we ended up selling all that to the point where I own nothing in Trenton except for we're building a 30-unit apartment complex there, which is a whole different game. But I look back at that time, and I have a friend that I still talk to that he owns everything himself. Did the BRRRR strategy over and over and over again. And he brought in investors, but only as lenders. Then he would refinance them out and then rinse and repeat, do it over again. And he has a portfolio of about 250, 300 units. And he does very, very well, but he's still in the minutia, does a lot of the showings himself. He meets contractors himself. He likes being in the day-to-day. Not that I don't want to be in the day-to-day, but I think it's very tough to scale. Yes, I've had to take a lot of dilutions. I certainly don't own 2,000 units all by myself. It'd be lovely to say that I do, but I don't. I have a large family of investors that have joined us on that and our income fund and everything. But I think that the testament to scaling, as we did, allows us to take on different team members and those things, and just you really can lean into what your greatness is when you syndicate and you bring in investors, because larger deals do bring in larger checks of profitability and, yes, fees. Syndicators, this isn't a hobby. We do make fees when we do these deals, and if you're smart with the fees, you can recycle them back into your business and hire top tier A+ people. My buddy in Trenton can't do that. He's got him and like 2 staff members. He does very, very well financially, but he's also in it. Like, he is the business
Mhm.
in that. So I compare myself to him sometimes, but it's okay. But I still would rather be doing what I'm doing, because I'm able to really focus on what I'm great at only. And I don't have to do any of the stuff that I'm not, because of the size of the companies, able to employ people that are in their box of greatness. That's what they do, and what they do only for the company.
Yeah, the difference really is you're running a business when you're a
Yep.
syndicator versus you're an investor,
Hmm.
keeping all the profits.
Yeah.
And it's whatever works for you, or both, ideally both, right? Some of the profits from the business should be channeled into
Hope
your
so.
own
Yeah.
portfolio.
Yeah. It
Yeah.
depends on the day, right? Yeah.
Yeah. Yeah, exactly.
Yeah.
Okay, well, there's a lot going on out there
Hmm.
today. um,
Sure is, man. Wow.
yeah.
Yeah.
What's your read? You and I have been doing this a while, like you said, over 20 years.
Yeah.
Have you seen a market like this before?
I have not. It's funny, man. I was with you out. I think we were out in Chicago at like I think the Mid Atlantic thing or something like that. And the market was humming along. It was really hot. And my friend, said, like, it's like you were a sage, crystal ball in your pocket or something like that. You're like, Matt, there's all this floating rate debt out there right now. What happens if those rates change? And I was like, oh, that's a good point. I think I lost a little bit of sleep that night wondering about that. Like, oh, geez, Kathy's probably right. What if I can't get money, at 3%, for these bridge debt deals and stuff like that? Because now it's just changed everything. And so I think that we're in real estate is interesting because it changes, but it changes slowly. So I think that what I'm seeing now is rates are still high and sellers are slowly coming back down to reality. we're seeing cap rates slowly rise on some deals, and we're still seeing a slowly rising affinity and desirability to get back into the market from investors and for capital and for operators like you and me. So I think things are slowly warming up. People are accepting that, the whole survive till 2025 thing. People thought that the party would be back on by 2025 and rates would be back down, and this rate thing would be just a little blip. It's certainly not, right? So I think that people are accepting what the world we're in now as a bit of a new reality. I'm starting to see a few deals get done with regards to workouts with banks and that I don't think we're in a blood in the street market, Kathy. I don't think that we will be, but I think there'll be more and more workouts and more accepting of reality for those that own properties that are upside down, and for people looking to sell that are looking to just take real numbers for their properties versus like pie in the sky. I want to sell it for double what I paid for it 2 years ago, kind of thing. So I'm cautiously optimistic that things are starting to open up a bit, all in. That said, we haven't done very many deals the last 2 years because the last 2 years it's been like trying to force a square peg into a round hole. So,
Yeah.
but I'm cautiously optimistic that that's going to change.
Yeah, change in terms, and again, we're talking multifamily, very different than the single family market. And I think
Yep.
that's so important to make that distinction.
Mm-hmm. Yes.
Multifamily mostly is in short term debt, that is due. And it's very
Yep.
similar to what happened to residential housing or 1 to 4 unit in 2008, where
Mm-hmm.
loans adjusted, people couldn't make the payments and properties went into foreclosure.
Mm-hmm.
Banks learned we don't really like to put a bunch of properties in foreclosure. That's not good for our asset values.
Yeah.
So, but that's kind of where the banks are, is they've got a bunch of properties where the payments have adjusted in multifamily and the banks don't really want them back.
Yeah.
There's this extend and pretend thing going on, I think, with the banks again.
Mm-hmm.
But I think what I hear you saying is it's not going to crash.
No.
There will be some deals that go
Mm-hmm.
into foreclosure, and that's when
100%.
they end up in the real deal.
Yep. Yeah. I
Which,
think that what like the black swan that could really throw this thing off is if there is a major hit to the U.S. economy from a recession standpoint or something like that. And again, now I feel like Kathy Fettke up on stage at a conference with my charts and all that kind of stuff, like like where you're like, oh, when this line does this, if that line does that. Because I've learned a lot from you over the years at conferences when you
oh,
break the charts down. So I'll give my best to do my Kathy Fettke impression.
thank
So
you.
if there is a recession that is severe in the U.S., it will pull down the revenue for the workforce housing of America, like those that live in B and C class real estate. If that happens, you will see banks saying, okay, no more extend and pretend, because now your C class that was plugging along at 90% occupancy, just barely able to keep its head above water, is now at 70% economic, meaning like only 70% of the tenant base can pay their rent. Then the bank is going to say, okay, party off. Now give me the keys, and that there will be no more extend and pretend. And the banks are tolerant with a lot of operators because they see that their revenue is coming in. These properties are current on their mortgage. If that starts to become threatened, it's party on, it's game over. And so yet to be seen. There's a lot of variables right now with tariffs and, stock market and all the things that then flow down into people's, the working America's revenue, and what causes them to get their paychecks and stops them from getting laid off and all that other jazz, right? So I think that's the black swan. I don't think it's going to happen. I think we could certainly have a normalization or a correction in the stock market, which could put a little bit of pressure. But I'm talking about something that would drop like, what 1 in 6, 1 in 7 Americans lose their job, something like that. That would
So
be
more of a job loss situation versus the stock market,
yeah.
because we just saw the stock market, take a major hit, and now it's back up. So
Yeah,
that's
that was a
good.
flip. Yeah, I know, right?
That's
But
good.
it doesn't. If the stock market takes a hit, or if other companies decide they're going to start doing hiring freezes or layoffs or whatever, as we saw in 07 and 08, because I was investing back then, so were you. So anything out there that causes companies to really pull back on revenue, to say, okay, we just can't afford this workforce that we have. And so you just start having mass layoffs and everything like that. Companies start going dark or shuttering or something like that. That happens. That will flow directly over to multifamily, just housing in general, not just multifamily, housing, because Americans pay for their housing in one form or another through earned income from a job. And so if earned income from jobs becomes threatened, that will affect all housing, I believe.
Yeah, I agree. I
Yeah.
guess with my crystal ball, I would
Yeah. Break
say,
it out, Kath. Teach me
I don't,
what you got.
you teach me.
You can be right. I'll
And,
believe whatever you say. I'm going to believe you already. So go ahead.
I just look at the fact of the matter that we have a president who doesn't want to see that happen. So,
Yeah, nobody wants. That's the thing, and he's
yeah,
got all the means at his hands.
yeah,
He's an economically minded guy, so I think that if things start to sniff that way, I think that he will do whatever he can to prevent it from happening. So,
yeah.
yeah,
That's kind of my thought too. So at least I think we're okay for a year and a half until things change, if things change. But
yeah,
I think there's a lot at stake. So, again, that's just we've already seen him pivot, right?
yeah,
He
yeah, yeah.
tried
Oh, I
something,
know.
didn't
He's
work.
Captain Pivot. Yeah,
Yeah,
I feel like we're playing poker with the guy, and
yeah,
he only he can see his cards, because he's very good at keeping his cards close to his chest about what his plans are and all that. But I do think he's certainly watching the economy and watching how his actions are affecting it.
yeah,
So
yeah.
yeah,
And I think possibly surprised by it. So,
yeah,
and wanting to correct that because that would be everything.
yeah, yeah,
It's the
absolutely.
economy, stupid, right? Like
Yeah,
it has
he's watching.
he has to turn
He's
it
paying
around.
attention. Yeah.
Yeah.
So
So that's what I'm going to hold on to, that it's going to, that there's not a recession coming. Nobody ever knows, but it's
no,
always
no.
important to be prepared for one no matter what.
And that's what, and if a recession did happen, Kath, what's interesting is that because maybe this is like the silver lining or why the Fed did not like drastically start dropping rates when the economy started showing some signs of creaking and slowing down over the last year or two. The Fed has a lot of bullets in their gun that they could throw at a slowing economy if they
Yes.
chose to. So
Hmm.
if we had a recession, the Fed could start drastically dropping rates, which, as is throwing some real fuel, real support to the economy. So if rates were still sitting where they were a couple of years ago, like 0.5% or something like that, they're out of bullets. But now they've got real support they could throw at an economy if we did decide to hiccup a little bit. So
Yeah.
that's why I called a drastically falling economy, a drastically falling jobs market, a black swan event, because I think that I don't see it as really probable. And I think that you could doomsday all day long, but I think what's likely going to happen is we're going to muddle our way through what we're at here. We'll probably see a boom, another heyday, in that, which is
Yeah.
why I think that it's good to buy what you can, because I think that you'll probably see another, if the Fed starts cutting rates again, what's it going to do to real estate? That's going to help real estate out quite a bit,
A
right?
lot. Yeah.
Yeah, and I think somebody's going to throw the party on switch if and you're going to wish you bought more now. That's what I really, my gut says, that now, believe it or not, is actually a good time to buy, because we might go to party mode in 2026 with rates coming down a little bit and with cap rates compressing a little bit more and all that. So that's my
I'm in the same camp. I
yeah.
told my daughter when the stock market, you know, dipped to a slow
Sneezed.
point. I was like,
Yeah.
girl, get in, get
Do
in. This
that.
is the
Look at it
time.
now. Look at it
Ah,
now, man. You got to buy the dip. Got to buy
you
the dip.
gotta buy the dip. And how do you know you're in a dip? It's when everybody's scared. That's when you know
100%.
you're in a dip. And yet the
Oh yeah.
fundamentals need to be in place, which,
People sure were, man.
yeah.
I'll give you a crazy thing that DeRosa, our company's doing. That's not crazy. It's brilliant, I think. That the market sector, the asset class that I think is going to do really, really well in the next the next couple of years, believe it or not, is the more utility hospitality space. So not bougie swanky hotels. I'm talking about the hotels that serve you free breakfast, the hotels that, are in good usable areas that are utilized by everyone from business travelers like you and me, to people taking their kids to a soccer tournament in the next town over. Right. So our company is aggressively going after hotels, not just multifamily. We're still love multifamily, but a hotel is in essence a multifamily box that rents by the day versus by the month, right? So we are under contract on 2 of those, high end brand, like nameable brand, like Hilton brand, Marriott brand hotels that are like, extended stays or, rent by the night, but with free breakfast and, more like made for the business and family traveler.
Oh, very exciting.
Yeah,
Very
man.
exciting. Now that I
Yeah.
do short-term rentals, I see the power of good stuff.
Mm-hmm.
Matt, we obviously have to have you back another time, but
Why
thank
not?
you so much for sharing your
You and I
insights.
have good banter. I miss you, Kathy Fettke. Thank you for bringing me on today. And I want to come on and banter and have some laughs and all that with you again soon.
I'd love that. Oh, miss you too. Good to see you.
Yeah. Thank you.
I'm Kathy Fettke. Thanks so much for joining me here on The Real Wealth Show, and we'll see you next time.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.